Contract modification. On January 1st, 2019, Loud Company enters into a 2-year contract with a customer for an unlimited talk and 5 gig data wireless plan for $65 per month. The contract includes a smartphone for which the customer pays $299. Loud also sells the smartphone and monthly service plans separately, charging $649 for the smartphone and $65 for the monthly service for the unlimited talk and 5G data wireless plan. On July 1st, 2019, the customer realizes that she needs less data in her wireless plan and downgrades to unlimited talk and 2 gig data plan for the remaining term of the contract, which is 18 months. The unlimited talk and the 2 gig data plan is priced at $55 per month. The $55 per month is Loud's current standalone price for this plan that is available to all customers. So the first part is asking, how should Loud account for this contract modification? And so in the platform, it gives us a sentence with these drop downs, and I just already filled them in. The contract modification does not add goods or services to the arrangement. Therefore, this modification cannot be treated as a separate contract. However, to determine the appropriate accounting for this modification, the entity has to assess whether the remaining goods and services, the 18 months of service, are distinct from the goods and services already provided to the customer. So that handset and 6 months of service. And so then it's asking us to fill out this. On July 1st, the contract receivable has a remaining balance of blank. As a result, the entity has blank to allocate to the remaining 18 months of service or blank per month. And so we will go ahead and figure that out. And so let's first just figure this part. It's saying we have to assess whether the remaining goods and services are distinct from the goods and services already provided. And they are distinct. And so therefore, at the date of modification, we're going to determine the remaining monthly services versus what was already allocated or provided by the customer, and determine the remaining performance obligation. So let's start with, we really kind of need to go backwards and figure out how it was allocated to begin with for the first 6 months. And so to do that, we're going to look at the phone as well as the service. And the phone looks like the price was $299, but it had a standalone charge of $649. With the service, it's $65 per month, so 65 times 24. And that was the standalone as well. So it'll be that same $1,560. And let's add these together. And so we have a total price of $1,859 over the contract that would have been $2,209. And so down here, I'm going to divide our $1,859 divided by our $2,209 for this 84, roughly 84%. And we're going to use that to allocate this standalone pricing. And so $649 times that percentage gives us $546.17. And same thing, the $1,560 times that 84 gives us $1,312. And if we add those together, we're going to have that same $1,859. And so this is allowing us to figure out how to allocate the monthly payments towards the phone, so that contract receivable versus the service or just sales revenue. And so at the time of the sale, we would have allocated $299 towards the phone. So we have $546 minus that $299 leaves $247.17 that will have to be allocated over the life of the plan, or the 24 months. So if we divide 247.17 divided by 24 months, we get 1030. Each month, that would be the contract receivable. So now that we have that information that really would have pertained like to steps before we got to this point, we can use it to figure out what the contract receivable is as of July 1st. And so to do that, we can take the 247 minus the 1030 times the 6 months that have passed, and we get 185.38. So as a result, the entity has blank to allocate to the remaining 18 months of service, or blank per month. And so let's figure out the remaining 18 months of service would be equal to 55 times 18 months, or 990. And so that gives us 990 minus the 185.38 for 804.62. And then we can just divide that by 18 months to get a monthly rate of 44.70. All right. And so then the second part of the question is to prepare the journal entry to record the cash received for the monthly service plan on July 1st. And so to do that, we'd be receiving cash, and this would be $55. And then we're going to have a credit to our contract receivable and a credit to our sales revenue. And the contract receivable we previously calculated as 1030, which means that the difference, that 55 minus 1030, gives us 44.70 to the sales revenue, which aligns with what we had calculated previously when we had these blanks, how much we'd be allocating to the service each month.